Hey, do you want to make use of that home equity that you've built in your current home in order to go buy more real estate? Maybe you want to go buy your dream home or that second home up in Duluth you've been looking for. If you've got equity in your home, there are ways to make use of it towards building wealth in real estate without having to sell your home. Hey, I'm Peter Lindquist. I've been a mortgage lender in Minnesota for over 30 years, and I want to share that experience with you in today's video. And if you like today's video, please be sure to give it a thumbs up. You know, it does an awful lot to support the channel. And speaking of that, if you're wanting to buy a home, subscribe to the channel. There's a lot of stuff that I come out with that you're not going to want to miss. So what is home equity? It is the value of your home minus whatever your current mortgage is. So if your house is worth $500,000 and you owe $400,000, the difference between those two is $100,000. So you've got $100,000 of home equity. The way you build equity is your mortgage payments, you are paying down the principal with each payment, so you owe less and less each month. And then there's market conditions. If your house is rising in value, then you're building equity that way. If it's shrinking in value, then you're losing equity. So there's four main ways to access your home equity. I'm going to talk about the three most common ones first, and those are home equity loans. These type of loans, you leave your current mortgage in place. And that's important in today's world because chances are you've got a very low interest rate, 3% or something, but then you've got this equity. So a home equity loan is a loan that is secured by that equity. And since it's secured, it is a lower interest rate because investors in your home feel like it's a safer investment. Three different types of home equity loans. One is a line of credit called a home equity line of credit, otherwise known as a HELOC. And these are essentially like a big credit card that is secured by your home. You can draw on it, pay it back down just like you do with a credit card. And that's really where the big value is. Also, they will tend to lend you more on a home equity line of credit than they will on the next two loans that I'm going to talk to you about. But there's a downside, and that is that it's a variable rate. And it's a variable rate that can change every month as it really depends on what the Federal Reserve does with interest rates in most cases. But you can use the money from that loan that you draw from the equity in your home. You can use that towards the purchase of real estate. So that's the most common. The next one is a home equity loan. And the attractive part to these is that they'll have a fixed rate, at least for a period of time. What's most common is a home equity loan that goes with a 5-year or 7-year balloon, and the payments are arranged over maybe a 20-year time frame. But it would be rare for those to actually have a fixed rate over those 20 years. A balloon means that at the end of that term, so if it's called a 5-year balloon, at the end of 5 years, the note comes due. So you have to pay it off, typically by refinancing it. And with these, it's a lump sum. So you borrow the money, now you've got it, and you can use it for the purchase of other real estate. These are ideal if you're concerned about what's going to happen to interest rates over the coming years and you prefer having a fixed payment. The third type of financing is new, and it's something that we offer. It's kind of a hybrid between a fixed rate and a home equity line of credit because it actually is a fixed rate and it is a line of credit. What's different is that unlike a line of credit where you can pay it down and redraw several times, that's not the way this one works. They'll let you pay it down and redraw, but over a limited period of time. But the big benefit is it's a fixed rate and that it's amortized over 20 or even 30 years. It's similar to a first mortgage in that way that it can keep the payments low on that second mortgage. Now, interest rates on all of these are going to be higher than what a typical first mortgage rate is, because there's more risk involved with any type of second mortgage. And just a quick note on this home equity line of credit, I'm going to tell you a little bit later in this video how you can find out today on my website instantaneously what kind of term and rate and whether you're approved. You can find it out all right away right after this video. The fourth way that you can do this is not as common in today's world. At some point it will be, and that is a cash out refinance. That's where you owe $100,000 on your home and it's worth $300,000, and we do one big loan for $225,000. Now you're taking out $125,000 of your equity. That's not as common in today's environment, because if you've got a 3% mortgage, whatever cash out refinance we do is going to have a higher interest rate. That's why home equity loans tend to be more common. But if you are in a situation where you've got a higher interest rate on your mortgage, that would be another way that you could make good use of your home equity. So I wouldn't advise you using your home equity just for any reason. For example, I don't typically suggest using it for debt consolidation unless you're in kind of dire circumstances. But so where is a smart way to use it? One is if you are trying to buy your next home and you're finding that sellers will not take your offer that is contingent upon the sale of your home. That's a difficult offer to get accepted. If you've got equity in your home and if you can qualify for it all, you can get some type of equity loan, often referred to as a bridge loan, in which you get the money from that house, you're going to use it for the down payment of the new house. So that's one smart way. Another would be you're buying an investment property. And so now you're short on the down payment that you need, because down payments for investment properties are at minimum 15%, but those are really high rates. 20 and 25% ends up getting better. And so if you don't have that kind of cash available, a home equity loan is good for that. You're using that as the down payment on your investment property. You've got some equity remaining in your current home, and now you've got equity in the other home. Both of these homes now are building equity in the same way. Market is appreciating and you're paying the principal down, assuming that the market appreciates. Or another one would be, if you want to keep your fixed rate on your old house and you're willing to rent it out. So now get a home equity loan on your current house. You're going to use rents from your old house to pay those mortgage payments. And now you've taken the equity from your old house and you're essentially putting it into the new house. And that way you can keep your low rate on your first mortgage and get the dream home that you've been waiting for too long in order to buy. That's another smart use of a home equity loan. One thing I do want to note is that if you've got a higher interest rate currently and you're thinking about doing this, I'm going to suggest you look into refinancing that mortgage before you place your home equity. Because once you place a home equity loan as a second mortgage on your current home, now it becomes more expensive for you to refinance your current home, because Fannie Mae and Freddie Mac make it more expensive if you've got two mortgages on your home. So to avoid that expense, refinance right away first and then do your home equity loan. And a big caveat that I want to make to all of this, understand that with a home equity loan, it's not like a car loan where if you sell your house, you can keep your car loan when you go to the new house. No, with the home equity loan, when you sell your house, you have to pay it off. And unlike a car loan where if you don't make your payments, you lose your car. If you don't make your payments on your home equity loan, you lose your house. So if you're borrowing from your home equity, I really suggest that you're doing it in a smart way. You're using it for something that is going to gain you value in one way or another. It is one big way that people build wealth in real estate. They build equity in one or more properties, borrow against it towards the purchase of additional properties. Now, I told you about that home equity loan you can find on my website. Go about halfway down, you're going to see the application button. It'll just take you a few minutes to enter the information. Don't worry, it's not going to be a hard credit inquiry. It's a soft credit inquiry, so it has no impact on you whatsoever. If it can give you a loan, it's going to give you the data right then and there. So you'll find out what the interest rate is, what the term is, what the payments are. So you might as well find out what kind of equity you can get. I do want to note that it's an automated process. So it's an automated appraisal. There's no option for a manual appraisal on the property. So if you disagree with whatever it says, there's nothing we can really do. But hey, the application doesn't cost you anything, so you might as well try it. Hey, thanks for joining me today. My name is Peter Lindquist. I would love to help you out with this or anything else in the mortgage world. Remember to subscribe to the channel and have a great day.